Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. It's an exciting time to be invested in Japan. Despite recent volatility, it has been a landmark year for Japanese markets, with the Japanese stock market hitting a 34-year high in February. This has been driven by a range of governance reforms, as well as a move away from a deflationary environment. With the Japan and Japanese smaller company sectors trading at a 10% and 8% discount respectively, could now be the time for investors to take a look at the world's fourth largest economy. Today, I'm delighted to be joined by three managers from the Japan and Japanese smaller company sectors. Richard Aston, Portfolio Manager of CC Japan Income and Growth Trust, Masaki Taketsume, Fund Manager of Schroder Japan Trust, and Paul Ffolkes Davis, Chairman of Rising Sun Management Ltd, which advises Nippon Active Value Fund. Right, on to the questions. What are the drivers behind the rally in the Japanese stock market over the past 12 months? I'm going to kick off with Richard.
Great, thank you, Annabelle. I think that the drivers are actually very consistent, and they've been very important in driving the market over the last few years. First is valuation. Japanese equities historically had traded at a fairly significant premium to global equities. The derating of 10 years ago really left them at comparable valuations, or in many cases, more attractive valuations, the international peer group. Secondly is the commitment to reform. And I think the period over the pandemic has really demonstrated very clearly that companies in Japan and Japan in general is committed to the reform and restructuring goals established by former Prime Minister Abe. And finally, a reassessment of the growth outlook. And I think there are a number of very, very exciting developments that enhance the growth outlook in coming years. The first is a shift from deflation to inflation. Second, the geopolitical fallout and a reorganizing of global supply chains is really benefiting many, many Japanese companies.
Thanks very much, Richard. So three main factors. Masaki, what's your view on this? What's driving the rally?
Yeah, I think there are two drivers for the last rally for the last 12 months. One is inflation. Another is corporate governance improvement. Inflation is a positive for the corporate earnings because now Japanese corporation can grow the revenue and the earnings through the combination of both volume growth and price increases, rate of which was absent for the last 30 years of the deflationary era. So inflation is a positive for the corporate earnings prospect. And in terms of corporate governance improvement, that's a positive for the valuation. So for the last 10 years, thanks partly to the corporate governance improvement, return on equity, ROE of the average Japanese corporation has been more than doubled from 4% to more than 8%. That's a positive impact for the corporate overall equity market valuation. So inflation drives the corporate earnings growth, corporate governance improvement leads to the devaluation for the Japanese equity market. I think that's the major reason for the last 12 months rally. Yeah.
Thank you so much, Masaki. That's actually a very clear explanation. Paul, have you got something to add about this?
Only that this is somewhat coming. I mean, the Japanese market has been demonstrably the cheapest developed market in the world for many years. And there have been several false storms when people thought that it was going to start to improve on a sustained basis and hasn't made it. This time, we think is different. Both Richard and Masaki have touched on why. Principally, the corporate governance reform program is coming from someone who is the largest investor in Japanese equities, and that is the government itself, Japan Inc., in the form of the Ministry of Finance and the State Pension Fund. And as such, there's a tremendous sort of wind at the back of corporations to improve their capital allocation and all that all of us as managers are trying to promote. Inflation, of course, has started to become a factor, but largely after the rally began. I think perhaps the one thing that hasn't been mentioned so far is a reorganization of international currency flows out of China, because there is a clear decoupling going on in terms of US dollar and European investment processes out of China, and they need somewhere else to go in Southeast Asia. They're going into Japan because it is such a good value market.
That's a very interesting point there, Paul, and we haven't heard about that before. Right, now can this rally be sustained, or is it running out of steam, or is it pausing for breath? I'm going to kick off with Masaki.
Yes, I think current rally is sustainable because the underlying driver, inflation and the corporate governance improvement, are the long-term structural tailwind. In terms of the inflation, it is not just benefiting the pricing power for the corporate, but also have a long-term implication for the Japanese economy. Inflation implies an increasing cost of holding cash. So that may lead to the release of the excess cash on the corporate balance sheet, as well as the household financial asset, so which is largely in a bank deposit. So under the inflationary environment, corporate may utilize their excess cash on the balance sheet for the investment, for the productivity improvement. And in the case of the household, they may reallocate the bank deposit, cash from bank deposit to the investment into the equity market. So that means that the Japanese economy may get a boost from the investment-driven growth. That's a positive aspect, long-term positive aspect for the inflation. In the case of the corporate governance improvement, while there has been the improvement for the last 10 years, there remains much more room to further improvement because still 30 to 40% of the Japanese company holds the excess cash on the balance sheet, and 40% of the Japanese stock is still being traded below one-time price to book. So there's much room for the improvement in that category, that part of the market through the corporate governance improvement. So all in all, we believe that the inflation and the corporate governance improvement are the long-term structural driver for the Japanese equity market. Yeah.
Thank you very much. Paul, what do you think about this? Is the market just pausing for breath? Are these corporate governance reforms going to continue to drive growth? What do you think?
Well, I think that Masaki has nailed it, actually, and clearly he's right. We don't believe that the corporate governance reform program is either going to let up or disappear. It will continue, and as I said earlier, the market was demonstrably the cheapest in the world. It is still demonstrably the cheapest in the world, of developed markets at least, and quite a bit cheaper than some emerging markets. So we think that there's a long way to go. And I'll go back to my investment flows argument and suggest that there is a new element that is starting to be seen, which was to do with the correction in the yen and the ending of the negative interest rate environment. You're starting to see domestic investors taking more of an interest in their own stock market, and the introduction of the NISA, modeled on the US ISA program, means that Mrs. Watanabe might finally beginning to get in on the act as well. So there is a kind of wall of money that is still available to go into Japan, quite apart from the international wall of money that has already been seen, most obviously, for example, with Warren Buffett and the investments he made in the trading companies over a year ago, and he's done so well out of. So there's a lot of interest in the market. The market's still cheap.
Yes, and if we can get that wall of domestic money going into Japan, obviously that could make a very big difference.
Yeah.
And Richard, what do you think? Is this rally sustainable? Is it pausing for breath? What's going on?
Yeah, I think despite the strong run in 2023 in particular, market valuations are still within very, very tight ranges that have been established in the Abenomics period. So that given the expectations for further improvement in corporate capital efficiency, the corporate governance reforms, shareholder returns in general, mean that there's significant further upside within the market. So if we add to that maybe increased confidence in growth outlook for companies in Japan and the shift from deflation to inflation, I think this ensures that the market will continue with this strong upward trajectory.
Right. Well, let's hope you're right, definitely. Paul, I'd like to now ask, where are you currently finding opportunities? You've got a very specific investment strategy. And could you give us an example or two of current stocks that you're finding opportunities?
Yes. I think we're doing something slightly different from Richard and Masaki in the sense that we're activist investors. We're not always looking for the best company. We're certainly not looking for bad ones. But what we're looking for are companies that have certain characteristics, particularly a reasonable business that is largely domestically focused, too much cash or cross shareholdings or property on the balance sheet that allows the everyman or salaryman rather managements of these companies to sleep well at night. Companies that aren't terribly well followed by research analysts generally, and certainly not by international research analysts. So there isn't any English language research on most of our companies that allows us to do the fundamental digging. And companies with a reasonably open share register. We don't want companies that can hide behind all their traditional cross-shareholdings and their pals, or indeed the companies that they sell up to if they're part of somebody else's supply chain. We want companies that we can influence and we can talk to. So given all of that, our sort of criteria is slightly different. We're not looking for a company that is necessarily fundamentally the best in its space. Even the second, third, fourth, and fifth companies that do the same thing are of interest to us. And in fact, many of those are more easily influenced than the first one. Companies that we're currently engaged with, well, we're having a public spat with Fuji Media Holdings, which is Japan's second largest broadcaster. All broadcasting companies in Japan are very cheap. Traditionally, foreign investors don't get terribly involved with them because they have a rule they're protected by the Broadcasting Act, and only 20% of their shares are available to international investors. And as such, normally activists would be the last person or last type of investor who would get involved. This company, though, its ROE is struggling to reach 5%, and the Tokyo Stock Exchange is saying that all companies should target at least 8%. It's trading at 0.4 of 1 times book. So it is ludicrously cheap. We don't necessarily think they will do all the things we're asking them to do. And principally, we're suggesting that they carry out an MBO. But we do think that our voice, married to the regulators asking for better capital allocation and all the pressures that come to them from the corporate governance reform program, will eventually cause them to do something. And that's all we really need. We want companies to do something to help themselves, or to be taken private by PE or indeed by their own managements. And that allows us to exit at a good turn. So that's an example of one company we're engaged with. There are obviously in a portfolio of 32. We can't engage with all of them all the time, but we are pretty active at the moment with 10 to 11 companies, not all of which are as recalcitrant as Fuji Media Holdings has proved to be.
Well, it does sound interesting, that active approach, getting those companies to do something. Very interesting. Richard, where are you finding these opportunities at the moment?
Thank you. Yeah, we see financial sectors as key beneficiaries of the normalisation of monetary policy that we're currently experiencing in Japan. And the sectors such as bank and insurance have really operated and learned to operate in a zero and negative interest rate environment, and they're really reaping the higher returns as interest rates start to rise. And we think these sectors actually have been right at the forefront of the improvement in corporate governance. And as a result of that, we're seeing very, very significant improvements in capital efficiency and direct returns to us as shareholders through dividends and share buybacks. Equally, I think mid and small cap stocks, which have underperformed the rising market, are actually presenting many more attractive opportunities. We tend to focus on well-established companies with very, very strong financial characteristics, management capability, and probably importantly for us, sort of very strong competitive positioning. So, companies like Nippon Packaging, which are a world-leading supplier to the semiconductor production equipment industry, companies like Mani, which are certainly regionally very well-established medical product supplier. It's these type of companies that we are very excited to be identifying at this stage.
Definitely. Those smaller mid-caps, very exciting. And Masaki, where are you finding opportunities at the moment?
Yeah. So basically, our positive view on the Japanese equity market is dependent on the inflation and the corporate governance improvement. And from viewpoint of the inflation, we like the company in the domestic service sector which has a strong pricing power, because that's a company that can realize the most benefit from the domestic inflation led by the wage growth. So one company we like is named ffolkes Maintenance. It's a business hotel operator under the brand name of the Domi Inn, and they have a pretty strong franchise value in that under the Domi Inn Hotel, and they have a strong pricing power. In fact, they already increased their room rate by more than 20% in the last year, and the current room rate is way above the 2019 because of the corona outbreak. So that suggests that they have a pretty strong pricing power in their business area, which should benefit their earnings growth under the inflationary environment. And in the case of the corporate governance improvement, we like the company called Toyota Industries, which is the origin company of the Toyota Motor Group. So one of the trends we are seeing under the corporate governance improvement is this solution of the cross-shareholding. And even the Toyota Motor Group is starting to dissolve the cross-shareholding. And the other origin of the Toyota Motor Group company, Toyota Industry, owns a significant amount of the stock of the Toyota Motor Group, like a Toyota Motor, Denso, Aishin, and that holding value is now worth more than their market cap. So once they dissolve or release the value of their shareholding, we're going to see the significant revaluation opportunity in the Toyota Industry. So that's another stock we like at this moment.
We've liked that well in the past. We've helped Toyota Industries.
Really interesting. Hotels, motors, Toyota. Interesting. Right. So, last question. What do you enjoy most about investing in Japan? And I'm going to ask Masaki, who's based in Tokyo right now, to answer that one.
Yeah. So one of the most interesting points in investing in Japanese equity is to identify the sort of the hidden dynamism under the one company. So sometimes Japanese equity market is criticized about the lack of the dynamism. Like in the case of the US, top 10 market cap company name is completely different compared to the 10 years ago. But in the case of Japan, it's the same old type of the criticism. But if we think of the, say, Sony, 10 or 15 years ago, it was a consumer electronics company. Now, Sony is a media or IP holder. Hitachi is now becoming the social infrastructure service company. 10, 20 years ago, that's a conglomerate. So underneath of the same old company name, there is a huge dynamic change in a business portfolio or capital management. So by doing that, we're going to see the significant improvement in ROIC or growth prospect. And that leads to the huge devaluation of the share price of such company like Sony and Hitachi. So that's a quite interesting investment opportunity we are finding in the Japanese equity market to identify such a sort of the hidden dynamism underneath of the same old name. Yeah.
I like that hidden dynamism that you're finding the same names, but there's something new and exciting going on inside.
Yeah.
That's really, really interesting. Richard, what do you like most about investing in Japan?
Well, I think the fact that Japan has always been under researched. So by that, I mean many companies have very little or even any sell-side research. I mean, there's a real value and reward for proprietary research and effort. And as the environment has changed, more understanding of the benefits of corporate governance, the opportunities to identify companies, to have dialogue with companies that are willing to conform to standards that I think investors internationally are very familiar with, makes it a very, very exciting place to spend time and to research. And from a personal standpoint, I think Japan as a nation sort of faces some of the challenges that many other countries in the future might well face, aging population. And I think it's very, very exciting to see how Japan copes with those challenges and really flourishes, actually.
Yeah, and I'm sure we can learn a lot from that ourselves in terms of how they cope with that. Paul, what do you really enjoy about investing in Japan?
Well, I'm going to go back to Masaki's hidden dynamism and say that in the smaller company sector, it's very well hidden. And one of the things that I enjoy most about this is the fact that you have so many perfectly good companies that are run so far below their potential, and they hide behind the Japanese formality that we're always hearing about, or the Japanese process that we're always hearing about. And it is quite nice for someone who is slightly iconoclastic as I am to come along and rough them up a bit. And I have enjoyed doing that. And, we had a discussion earlier today about the conversation you can have with a company where you describe yourself as their owner rather than their shareholder. Shareholder being just another stakeholder as far as they're concerned. But when you actually say, no, I own the company, and in some of these companies, we might hold as much as 30% of the company. We really do own it. The shock on their faces gives me a warm feeling inside.
I can understand that. The dynamics must be very interesting between you and the company and how you get them to evolve and change. Very interesting. I can understand you enjoy that a lot. Well, I'd really like to thank all our managers very much for joining us today. It's been great to hear their views. I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. But thanks so much for watching today.